Welcome to Insights into Insurance with Tom Sorensen of Americana Insurance Group. All information provided is educational in nature and not intended to be acted upon without first consulting the appropriately licensed professional.
Saturday morning here on KATE, and it's time once again for Insights into Insurance with Americana Insurance's Tom Sorensen. Tom, we've made it to the weekend, and actually the weekend before the fair.
It's incredible that that's the time. I just was told that the other day. Oh, next week is the fair, and I'm like, what? Really? And I'm like, oh, yeah, it is that time of the summer. So good morning, Paul.
Good morning. I can't believe it either. It seems like just yesterday I was shoveling my driveway, and tomorrow I will be too, it feels like.
Oh, God. Let's hope not.
Tom, we kind of have a repeat question here, but it's not necessarily a repeat. We've talked about it a little bit, but I think people will really be interested to find out more about this.
Yeah, well, I should say it's a big topic in insurance, but it's a topic that a lot of people don't know about their insurance.
All right, we'll get right to our listener email. Hello, Insights into Insurance. I have a farm and had a sizable claim with a fire in a machine shed. The insurance company did an inventory of all my farm equipment to make sure I was within co-insurance coverage. My claim worked out well, and I am happy with how my claim was taken care of, but I still question what co-insurance is or what they talked about a co-insurance penalty. Why did they have to do an inventory? I didn't get it. Signed, Happy but Confused.
Oh, yes, Happy but Confused. That's probably should be my name, but anyway, or just confused. I don't know.
No.
But anyway, let's talk about coinsurance and what type of policies and things like that have coinsurance. Or it actually is also known as coinsurance clause in most policies, in a lot of policies. Now, like if you're talking health insurance, you have a coinsurance. A lot of people have coinsurance where like it's health insurance is like an 80%, 20% example where the insured pays 20% of all the claims and the insurance company pays 80% until out-of-pocket maximum is reached, and then the insurance company pays 100%. Why do they do that? Because it keeps the cost down, and also know that co-pays and co-insurance are different on health insurance. You know, co-pays could be you got to pay $25 for every ER visit or whatever, so that's different than coinsurance. But another example is liability coinsurance. In example, like a directors and officers coverage, okay? The insuring company may require or the insured may request also in order to keep the premium down to share in a liability loss, okay? Most of our insurance policies do not have a deductible or a coinsurance with liability concerns. It usually pays out 100%, but there is options out there that you can do that. It's the risk sharing technique that can be used to basically it's get the insured to have skin in the game.
Okay.
And an example, the insured might be more cautious about things if they could have a potential of paying out a claim along with the insured. It could be a deductible. It could be a percentage of the claim. Example, if you have $1 million claim, and the insured shares 20%, which is $200,000, I think they would probably be a little bit more cautious about what they do instead of just thinking, because they have skin in the game.
Won't put the kerosene in the machine shed.
Right. Exactly. Yeah. Now, when we're talking happy but confused question, okay, I'm going to go over what his policy is, the farm policy, okay? This is kind of typical of farm and commercial. Let's talk about that scenario then. The farm machinery and equipment. On farm policies, most policies, if not all policies, have a 80% coinsurance clause on what we call Schedule F is what it's called on the policy, but it's blanket farm machinery and equipment. So I'm going to explain the claim. So now I have no idea what size a claim Happy but Confused had, but so let's just say an insured of mine, I'll just say an insured of mine has $1 million in farm machinery and equipment. This was figured out after the company has done an inventory. So after the claim happened, the company comes out and does an inventory of all the farm machinery and equipment. It includes everything from combines to tools to basically your nuts and bolts on the, in these jars that you hold. They'll inventory everything. The farmer has farm machinery and equipment insured on his policy for $500,000. and paid premium for only $500,000 or $500,000. Okay?
All right.
Well, a coinsurance clause requires that you have to have at least 80% of the actual inventory covered.
Generally speaking, with
Generally
this 80%.
speaking, yes, 80%. Now we're talking on this farm blanket, okay? So now it's not saying that by this 80%, if you have 80%, it'll pay up to the $1 million. No, it'll pay that you have to have at least 80% to have 100% of your claim covered, okay? I recommend having the $1 million worth of coverage, okay? Having 100% of it covered, okay? But it's hard to come up with a value sometimes, so that's where it gives you some leeway, okay? In this example, have $1 million of inventory. Now, he should at least have at least $800,000 insured on his policy. That's 80% of $1 million, right?
Yep.
Okay. He only had $500,000. This is an example.
50%.
50%. Okay. Farmer has a loss of $400,000. Okay. Now, up in Happy But Confused, he had a sizable claim of a machine shed burn. Okay. There's a lot of stuff in a machine shed. Okay. So $400,000 can easily happen. You take the $500,000 divided by the $800,000 of what the should have at least had equals 63%. So $400,000, and then you take 63% of $400,000 equals $252,000. That's what he'll get paid if he had a $400,000 loss but was only insured up to basically 50% of the actual inventory. That's a plus. On top of that, then his deductible will be taken out also. That's a kind of an ouch situation, you know.
Took a bath.
Right. Took a bath. Yep. So that's a coinsurance clause on like a farm blanket with this scenario, what he is asking as a question.
All right, Tom, I know there might be some people that own maybe a different type of business, and I'm guessing you probably have some answers for that too.
I do. Yes.
All right, we'll be back in 30 seconds with more on Insights to Insurance with Americana Insurance's Tom Sorensen.
Take us out to your ball game. Take us out to the crowd. We sell insurance for most anything. Who'd have guessed that the 18 could sing for its root? Root for good coverage. Americana's more than a name. For its 3-7-7-2000 for the insurance A-Team.
You'll be singing too when you see what the A-Team and Americana Insurance can do for you.
Let's take it from the top again. I think the rest of you were out of tune.
Back here on Insights into Insurance with Americana Insurance's Tom Sorensen. Tom, we had an email from Happy But Confused talking about co-insurance and co-insurance penalties. You just went through farm. Now we're going to talk more on commercial because we do know there's owners out there like that too.
Right, and I think we answered Happy But Confused's question and probably what he would want to know about what happened with his loss and why and what were they talking about. So, but there's other coinsurance situations or clauses out there that everybody should be aware of. Example, commercial buildings or commercial property. Normally that comes with a 80 to 90% coinsurance clause. Okay, so basically, we'll use the roundabout figure. If replacement cost of a commercial building is $100,000, okay, it should be at least insured, depending on the coinsurance clause, of 80% or 90%. So if it's 90%, it should at least have $90,000 worth of coverage on there to get replacement cost of any partial loss. Now, if he has a loss and he only has it insured at $100,000, but it should have been $120,000. Now again, there could be a situation where there's a coinsurance penalty.
Okay. I like that. Easy.
All right. So that example would be very similar to the farm equipment loss. Okay. Now there's another one with commercial is business income and extra expense. Very important. People that own businesses normally would have coverage for business income and extra expense. I'll talk about a scenario here, but normally it's based off of actual net income and operating expenses for 12 months. Normally comes with a coinsurance clause of 80 or 90%. So when you sign the policy, you're saying I want 80 or 90% insurance clause. The higher the clause, like 90%, the less the cost of the insurance. Less of a forgiveness is given by the insurance company. So you gotta be within that number. Okay. Example: small manufacturing plant that has a fire and is shut down for 3 months. It has a net income and operating expense of $2 million per year, again, has a co-insurance clause of 80%, which is $1.6 million, right? Of $2 million, yep. Insured had a limit on his policy of $1 million. If it was shut down for 3 months, you'd take $1 million would equal out to $500,000 of loss, okay? However, they only insured 50% of the actual net income and extra expense. So you take the $500,000, which ends up being that they, again, was at that 63% of what they actually should have been insured at, okay, equals $315,000 loss out of a $500,000 loss that they would collect. Okay, again, that could hurt. That would be a very ouchable situation. That sounds like something that Trump would say. He comes up with these words. Yeah. This is just a quick, easy example. There are other ways by doing business income and extra expense coverages and coinsurance, but this is always good to sit down with your agent and figure out what is the needs. Okay?
Can I get this, Tom, if I'm a new business? Because how can I actually give you actual net income and operating expenses, or do I have to wait a year in order to get this?
No, we actually do projections, okay? Now, if it's just a regular small little business, you actually can get it with what we call BOP policies. It automatically comes with it. But if you're a bigger, larger commercial, you actually have to come up with a number. And also, too, there's many ways of writing this and different options. You can discuss a possibility of how long would you think you would be out of business, okay, if certain thing happened. How quickly could you get rebuilt and up and running? And that you can take and potentially minimize the cost of the insurance, okay, but you also minimize the overall coverage too sometimes. Okay.
That goes back to a couple weeks ago. If people want to, they can go back and listen to that one too, where we talk about, having a plan. You need to have all that in place when you sit down with your agent, because that's what they want to hear.
Right. Exactly. Yep. Perfect. Yep.
Oh, how about a home, Tom? Can I get this on a home?
Yeah, this is going to be the one that's going to probably hit more of our listeners, okay, is surprise, many homeowners coverage comes with an 80% coinsurance clause penalty. However, normally if the insured is not covered within at least 80% of replacement costs, the policy will revert back to an actual cash value policy. What is actual cash value? It is replacement cost minus depreciation.
Yep.
Okay, that can hit hard. Okay, over my years that I've been in the business, I've had to turn away people because all of a sudden I do a replacement cost estimator on a house of $225,000, but they're saying, "Well, God, I don't want to insure it for that. I want to insure it for $125,000." I'm not going to put myself in that situation or them in that situation because they don't understand what the kind of situation they're putting themselves into. But you know what?
A leaky boat is what they're sitting in at that point.
Right. They are. But the sad fact is there is agents out there that will write it that way, okay, and not explain these items to them, okay? That's what's scary out there, okay? Now, again, 90% of the agents out there are very good people and will write it correctly, but there is some of those that give our industry a bad name. So there's some other things that you need to make sure is discuss this, because we actually have replacement cost estimators we can take the year of the house, the square footage, we can come up with a number. That's how we end up coming up with a number to begin with, okay? Well, if you're concerned about it and it's 5 years into the policy and you need to look at that again, no problem. We can do that. There's also something called modified replacement cost. Again, I could do a whole another show on that, but you can actually insure it for less than replacement cost, but still get replacement cost in any partial loss. Okay. Again, talk to your agent if that's anything that you're interested in. Otherwise, I guess the whole thing out of this conversation today is talk with your agent and discuss your options and discuss what could be a situation where a coinsurance situation could happen on any of your policies.
Tom, if people have questions and maybe they're not quite comfortable talking to their agent about this because they don't even know, right. What's a good number for them to call you?
377-2000.
Can they email us questions?
Yes, they can email me questions at insights@americanainsurance.com. And also, they can go to our website, americanainsurance.com.
Thanks, Tom. We'll talk next week.
Thanks, Paul.
You've been listening to Insights into Insurance from Americana Insurance Group. All information provided is intended to be educational in nature. Before acting upon any information obtained during the Insights into Insurance radio show broadcast, consult an appropriately licensed professional.